Hello, and welcome to Saving Circle, where we help millennial professionals feel confident about managing their money. I'm your host, Vineet Prasad. If you're looking for strategies to help you achieve your financial goals, you're in the right place. Today, we'll be talking with Mike Caligiuri, a certified financial planner, about the Backdoor Roth IRA, which is one of the most powerful financial strategies to save more for retirement while paying less taxes. Whether you want a refresher on the Backdoor Roth IRA or have never heard of it, this episode will be great for you. And as a reminder, the content discussed during this episode is for educational purposes only. It is not intended as investment advice, as it is impersonal and not specific to any listener's personal financial situation. And with that, let's get going. Mike, it's great to have you on the show. Thanks for joining.
Thanks for having me on. I'm excited to be here.
Perfect. Excellent. Well, before we dive into the Backdoor Roth IRA, which you're so kind as to come on and talk about, can you just tell us a little bit about what you do and the types of people you serve?
Sure. So I own my own fee-only wealth management firm. It's called Caligiuri Financial, and I primarily help physicians build wealth or sustain wealth or both. As they say, the art is not in making money, but in keeping it. So I let physicians make the money, and then I help them keep it and build it.
Oh, that's fantastic. You're absolutely right. You gotta. It's not enough to just earn the money. You gotta keep it and build it. I love it. So before we jump into the Roth IRA, one other thing I like to ask guests, just so that listeners can learn a little more about you. What is an unusual hobby or guilty pleasure that you enjoy?
Well, I'm shameless, so it's not a guilty pleasure, but certainly an unusual hobby I have is pretty much all day, every day, I listen to Buffalo Bills podcasts. And I only lived in Buffalo till I was 6 years old, Orchard Park, which is where the Buffalo Bills Stadium is at. And so I'll just listen to recordings of Buffalo media like WGR, the Howard and Jeremy show, Shopping the Bulldog, literally all throughout the day as I do mindless tasks when I walk on the treadmill. And then every Sunday I watch the Bills game along with the Red Zone on another TV. So I've got a 2 TV setup, one big screen TV with the Bills game, another big screen TV with Red Zone. And the Bills game's usually at 1 because they're on, East Coast time.
Mm-hmm.
And so I watch football from about 1 p.m. All the way to midnight through the Sunday night game. Not that my wife certainly doesn't like that, but it's just a reality that comes with being married to me as a diehard Bills fan.
Oh, that's awesome. I love it. That's a great one. And congratulations, by the way. I know you got married. Was it a month ago, 2 months ago?
Oh, who's counting? Wedding's over right now, but we got married about a month ago. So yeah, it's been great. Went on the honeymoon. It's in the books, and it's happily ever after now.
Fantastic. Excellent. Well, Bills are, as of when we're recording, the Bills are having a good season so far. So I'm guessing it's been fun for you.
Hey, that's right. And the Patriots are having a bad season, which makes the Bills season even better. So we're atop the AFC East 4-0, got a 2-game lead. Things are looking up.
All right, perfect. We'll see how that when this episode is launched, we'll see if they're holding up. Hopefully, will be.
Yeah.
But awesome. Well, let's dive into the Backdoor Roth IRA. And I'd love to start with just a question that might be on a lot of listeners' minds. What is a Backdoor Roth IRA?
Yeah, so backdoor Roth IRA or an IRA. I'm going to call it an IRA just because that's how I'm used to calling it. But some people call it an IRA. It's a way for people to get money into a Roth IRA without going through the normal means to do so. And so if you can do a normal Roth IRA contribution, it usually makes sense to do that so that you don't have to go through the hassle of doing the whole backdoor process. But if you are filing as a single person and you make over $124,000 a year, or if you're married filing jointly and making over $196,000 a year, Or if you're just if you're doing married filing separately for some student loans or something like that, what a lot of the listeners will know is that they've either already made a Roth IRA contribution and were told that they weren't supposed to do that, or if they're really smart, which I'm sure a lot of the listeners are since they're listening to the podcast or watching this on YouTube, is that they've actually looked into this ahead of time, thinking, well, wait a second, I'm making a lot of money now, above these limits, but I still want to get money into a Roth. Isn't there a way I can do that? And so the Backdoor Roth IRA is, it's kind of aptly named, right? It's kind of a backdoor way to get money in there, even though the normal rules don't allow you to put money into a Roth IRA in the normal way. So it's a little backhand way. I'll get into the specifics and the technicalities of it when you bring those up. But I think what listeners should know is that even if you're above the income limits for married filing jointly, if you're doing individually, or even married filing separately, for whatever reason you're doing that, student loans or liability reasons, whatever, there's still ways to get money into a Roth IRA without having to pay taxes or without having to get in trouble with the IRS.
All right, perfect. That was an excellent description of the backdoor Roth. And before we go into the kind of step-by-step process, I do want to zoom back and just ask the general question of, for those who are maybe less familiar, what is, generally speaking, the benefit of putting money in a Roth IRA in general? Roth IRA in general.
Yeah, that's a great question. A question I get a lot. The way to think about it is to compare it to a traditional IRA. And you can also compare it to what's called an after-tax brokerage account, which would just be you go on, Schwab, you open up an account, you've got a bunch of stocks in there, right? That's an after-tax brokerage account. And so all these accounts, whether it's a traditional IRA or Roth IRA or an after-tax brokerage account, they have different tax properties, okay? And so depending on your tax situation, some accounts are more advantageous than other accounts. Now with the traditional IRA, let's say that you make $50,000 a year and you put in $6,000 to a traditional IRA, which is the maximum that you can put in. You don't get taxed on the $50,000, you get taxed on the $44,000, which is $6,000 less than $50,000. So that's what it means to make a tax deductible contribution is you're deducting income from which you are taxed on, right? So, and then the Roth but the thing with the traditional IRA is that then when you go to take that $6,000 out that you had contributed to the traditional IRA, that money is fully taxable to you at your ordinary income tax rate. Right. So if your ordinary income tax rate, which you can look up by Googling that stuff, there are good websites for that. Smart Asset is a good website to go to if you're trying to figure out how much you're paying in taxes and what your brackets are. But when you pull the money out, you get taxed at your marginal income tax bracket. And so it's what you're trying to figure out is, is it worth it to do that, or is it worth it to do what's called a Roth IRA? And so a Roth, when you put the money in, let's do the same example. You're making $50,000 a year. You put $6,000 into the Roth, right? But here's the thing that a lot of people don't realize is that's not a tax deductible contribution. So you still get taxed on $50,000. But here's the kicker. The $6,000 is in the Roth. Let's say that grows to $20,000 50 years from now. For all the listeners who are saying, well, I just did on a calculator. That's not what it is. That's fine. This is an illustrative example. You put $60,000 in. It grows to $20,000, let's say after 50 years or whatever. And you take the money out and none of it gets taxed, right? So that's different than the traditional IRA, because the traditional IRA, you take the money out, it gets taxed. So traditional IRA, you get the deduction initially, but you get taxed when it comes out. A Roth IRA, you don't get the deduction, but it doesn't get taxed when it comes out. So when you think about which one should I do, usually what you have to ask yourself is, do I think the tax rate the tax rate that would have been applied to my deductible contribution, is that going to be higher or lower than the tax rate that's going to be applied when I take the money out, right? So you're trying to do a tax arbitrage. And so normally if people are in a really high income tax bracket right now, say they're in the 39% tax bracket, they're going to want to put money, they're going to try to get the tax deduction now, because they're going to say, well, but when I take the money out of this traditional IRA during retirement, I mean, I'm not going to be making as much money during retirement. So I think that my tax rate should be a lot lower at that time. So if you think your tax rate is going to be lower in the future, right, then you want to put in a traditional IRA. If you think your tax rate is going to be higher in the future and you take the money out, then you want to put it in the Roth IRA, right, initially. And so that also applies, to traditional IRA or traditional 401ks, 403bs, and Roth 401ks and Roth 403bs. Now, a lot of the listeners will be like, oh, well, I've got this all figured out now. But it gets more complex, because when you retire, let's say you need $100,000 a year to live on, you want to have the ability to take money out of pre-retirement accounts like a traditional IRA, traditional 401k. You also want to have the ability to take money out of a Roth IRA or Roth 401k that's not taxable to you, so you can take advantage of the marginal income tax bracket. So say you need $100,000 a year. Well, if you're married, the first $24,000 you take out because of the standard deduction, it's not taxed at all, right? So you got the deduction putting it in. You take 24 out during retirement, you don't get taxed on it. Then you could just take money out of a Roth, right? So that's an illustrative example. Right? So that's why it can help to have a diversified tax base within, your assets. That your assets are diversified from a tax perspective, in addition to an investment perspective.
That's phenomenal. I love it. I got we dove into not only what is a Roth IRA, but what is it versus a traditional IRA versus a regular brokerage account. And I think there's a lot of great information there, as well as I think about a lot and I think a lot of people don't think about that, like, especially if you're young, thinking about like the efficiency of withdrawing it and how it's like Batman's utility belt. You want to have, different things. You want to have your Roth money, your traditional pre-tax money. So that's awesome.
Yeah, and I'll just say one other thing here is, of course, what that is really applicable to are people who are nearing retirement, who are realizing they have all their assets in pre-tax and they're not really worth as much on an after-tax basis as they thought. Another important point to make is that because we don't know what future tax rates are going to be, you don't know what you should do right now, right? Because somebody could say, oh, well, there's no way my tax rate is going to be higher than it is now in the future. They don't know that, right? I used to work with a guy who had been an attorney his whole career, and he always used to say, Mike, you don't know that, right? So what do you know? You don't know what future tax rates are going to be. And because of that, it can be helpful to leave the ego at the door and just say, you know what? Let's just diversify the tax base. Let's get the best of both worlds. And in general, if you look at the marginal income tax bracket, the general advice, and I'm just looking at this thing on my screen here, would be that, if you're in the 32% marginal income tax bracket or above, generally advisors will recommend that you do pre-tax. If you're in the 22-24% bracket, advisors will generally recommend leaning more towards either doing a mix of pre-tax and Roth, and if you're below that, then definitely doing the Roth. And then the last point I want to make, I know I'm talking too much, but I want your listeners to get value out of this.
Yeah, absolutely.
I desperately want that. Is that one key difference between a Roth IRA and a traditional IRA, and the listeners will certainly appreciate this because I work with a lot of people who, when I tell them this, they go, oh, really? And it causes them to want to do the Roth more, is that you can always take whatever you contributed into a Roth IRA out without any penalty. And now somebody's going to say, well, no, you can't, because I looked up there's a 10% penalty. That's not true if you're looking at your contributions. You put in $6,000 to a Roth IRA, you can always take $6,000 out of that Roth IRA, no penalty, no tax consequences, right? Now, if you put in 6,000 and it grows to 10,000 and you want to take out more than 6,000, then you will pay taxes and penalty on the earnings, but not the contribution. With the traditional IRA, that's not true. You can't take out your contributions without paying taxes and an additional 10% penalty. So that's key, because what it really means to people, right, to kind of take it less from the academic and more to the practical, is that having money in a Roth IRA doesn't inhibit your liquidity as much as a traditional IRA would, because you're not subject to the same taxes and early distribution penalties.
Perfect. No, I that's a great point. And that when I learned about that Roth IRA piece, like, oh, you can take the money you put in out anytime, even though you know, it may not be the best idea, but that's awesome. It makes it one of the cooler tools on your utility belt. So I love it. Well, with that phenomenal context and backdrop, to at this point, you're probably like, oh my goodness, I'm so excited to put money in a Roth IRA. It's a powerful tool. So again, if now you realize you're over the income limit to where you can contribute to a Roth IRA, and you know now from Mike that how awesome it is. So how do you go about, what is kind of that step-by-step process to allow you to contribute to this Roth IRA?
Yeah, so the backdoor Roth IRA process is one where you make a non-deductible contribution to a traditional IRA, and then you convert that to a Roth IRA. Now, the first thing people are going to say is, no, because I make more than the limit to contribute to a traditional IRA, right? And you make more than you probably, a lot of the people listening, and I'll look it up on this sheet here, but if you make more than, because I want to be extremely clear, because this is a highly technical tax maneuver. If you make more than $75,000, and then you cannot make a deductible contribution in traditional IRA, but you can still make what's called a non-deductible contribution to an IRA, where you put money into it, you do not receive a tax deduction, and it just, for example, you could theoretically just leave that money in there as a non-deductible contribution. So people should know that you could, and some people decide just to do that. But for the sake of our conversation, I want to talk about the back door. So what's done is that you make a non-deductible contribution to a traditional IRA, and then you convert that via a Roth conversion is the technical name for it, to a Roth IRA. A lot of people say, well, no, because I read if you do that, then you're going to get taxed on that conversion. And you would if the original contribution you made to the traditional IRA was tax deductible. If you were to convert a tax deductible contribution to a traditional IRA, from a traditional IRA to a Roth IRA, that would be taxable in ordinary income tax bracket. But if you convert a non-deductible contribution from your traditional IRA to a Roth IRA, if you do it correctly, which I'm going to follow up here on a couple other items that you need to consider, you do not get taxed on that. Okay. So basically, what may be obvious to some people, but you'd be surprised, is that you need to open both a traditional IRA and a Roth IRA, right, in order to do this. That's probably obvious, but it's, trying to tell people how to do this. You got to open both accounts, and you need to make sure that you have the ability to move funds between the accounts, because you may or may not have that depending on whatever brokerage you use. So I can keep going if you want me to, or do you want to ask a question for me?
No, this is great. No, I think those are a lot of the key pieces. I think just kind of highlighting that Roth conversion and the process is key there. I guess let me, like, I think you're gonna probably next you're gonna go to some of the things to watch out for, but maybe let's transition into kind of what are some of the common mistakes that people could make around the backdoor Roth IRA process that you kind of want them, to avoid, or at least just be aware of.
Yeah, that's a great segue to what I was going to say anyway. And people make a lot of mistakes. It's not directing that at anybody in particular, but doing what I do, a lot of times, you find out that people are taking out contributions that they shouldn't have made. They did something wrong, and they're upset because they feel like somebody should have told them. And maybe that's the first thing to say is don't assume that somebody's going to say, oh, hey, by the way, you're doing this wrong, so you should fix it and do it the other way. That's kind of the natural impression a lot of people have is, well, how was I supposed to know that I didn't do it correctly? And it's like, well, actually you weren't. But the real question is, why didn't anybody let you know? And, it's because, they don't have to. Right.
Mm-hmm.
So if you're doing it wrong, you're not just going to know you're doing it wrong necessarily. At least you're not going to know because somebody's telling you doing it wrong. So that's one misconception is that, well, how was I supposed to know? And so here's a classic. Here's a classic thing is, okay, Mike, I did what you said. I contributed $6,000 to the traditional IRA. I converted to the Roth. And then, I get this big tax bill at the end of the year. What the heck? And what you tell them is, well, the brokerage that you're using to make the $6,000 Roth IRA contribution, they don't know that the contribution you made was non-deductible. Furthermore, when you plug everything into TurboTax instead of using an accountant, right? And you really don't pay attention to what you're inputting, and TurboTax just sees from your brokerage that a deductible contribution was made to a traditional IRA and it was converted to a Roth, and you've got the tax bill. And, not only that, but then now you're going to have some penalties because you shouldn't have made a deductible contribution in the first place, right? So it becomes this big, big mess. And so that's often what confuses people. So one thing that you need to make sure you do is you need to file what's called Form 8606. And, to the dismay of many listeners, yes, this means you may have to pay for TurboTax and upgrade to the next version. You may have to Google a step-by-step guide of how to do this, of how to file Form 8606. And what Form 8606 does is it lets the IRS know that the contribution you made to the traditional IRA was non-deductible, and so that'll result in you not being taxed on the conversion. So that's one thing they need to know. Another thing they need to know, and feel free to interrupt me, is that you should not, is that the best way or the most effective way to execute this backdoor Roth IRA strategy is if you do not have any pre-tax assets in your traditional IRA. Okay. And, this is another thing where people get confused. So, if you have $100,000 in a traditional IRA already of pre-tax assets because you rolled over an old 401k plan, or because you've done a great job of saving in there, from previous pre-tax, tax deductible contributions to traditional IRA when you used to have the ability to do that. If you try to do the backdoor while the pre-tax assets are in there, even if you file your little Form 8606, the IRS is going to say, oh, you have to pay tax on the conversion. Because what they're going to say is, okay, yeah, let's say there was $94,000 of pre-tax money in a traditional IRA, and you make a non-deductible contribution of $6,000, and then you convert $6,000 from your traditional IRA to the Roth. What the IRS is going to say, well, on a prorated basis, we're going to say that, since only $6,000 of the total $100,000 that was in that traditional IRA was non-deductible, we're going to say that only 6% of the conversion was non-deductible. So we're going to actually tax you on 94% of $6,000 when you convert that, right?
Yeah.
That's a lot of things that people don't realize. Now, there's a nice little backdoor way around that to do the backdoor Roth that I'm happy to share. Do you want me to go ahead and explain that?
Yeah. No, go ahead and jump in there. Yeah.
Yeah, so what happens a lot of times is, clients come to me and they come from an advisor who probably wasn't fee only and who probably wasn't even recommending the backdoor Roth contribution because it's kind of a pain to administer from the advisor's
Mm,
perspective. And so the prior advisor probably recommended the person who came to me to roll over all their old 401ks into an IRA so that
sure.
that advisor could manage it, because probably couldn't have built on the account if it was in what's called a held away account. It's pretty much what always
Mm,
happens. And so they've got all this money in a traditional IRA. And so what I tell them is, what you can do is you can actually take all this money that's in your traditional IRA and you can roll it into your employer-based retirement plan. So your
mm,
existing 401k. And then the client says, well, no, because that's only for if you're doing it the other way. And
mm,
no, that's not right. You could do it the other way too. So what you can do is, if your plan accepts rollovers, then you can
mm-hmm,
do that by looking at the SPD, the summary plan document or
mm-hmm.
description, or contacting your HR department if you don't want to do that, and ask them, does my plan accept rollovers? And I, quite honestly, at this point in my career, I've never seen a plan that does not accept rollovers.
Nice.
So you can roll over the assets from your traditional IRA into the 401k plan, and then boom, you don't have any money in your traditional IRA, and you can successfully do the backdoor Roth IRA contribution without being taxed on any of the money that was converted from your traditional IRA to the Roth IRA, right?
Yep.
And the point is just to make sure people don't think that, oh, wait, but you're missing it because the 401k has pre-tax assets. Yes, I understand that, but the technicalities of the rule are such that the IRS doesn't care if you have pre-tax assets in a 401k
Mm.
for the sake of doing a backdoor. It's only if it's a traditional IRA. Don't ask me why. I don't care. Doesn't matter. You shouldn't care. That's the solution. That's the answer.
I love it. So I'm just gonna summarize those points there because I think those are valuable. One, if you've already got money that's not deductible in your traditional IRA and you roll it over, some of that's going to be taxed. So watch out for that. Two, you can avoid that. You can move money from your traditional IRA to your existing pre-tax 401k. That's a great tip, and it's something for people to think about. And three, oh no, I lost it. The third one there, I had a good summation for it.
Form 8606.
Form 8606. Yeah. So I would say Google definitely if you're doing TurboTax, like TurboTax does, I believe, have a guide on like backdoor Roth IRA steps you need to take. So definitely do that. Personal story. I actually have been doing the backdoor Roth IRA for many years, and had 1 year where I forgot to fill in one of the forms, and I had to file an amendment and pay the government an extra $1 because I had forgotten to deal with the gains that came from like the 1 week that the money was in my traditional IRA. So anyway,
With the clients I work with, that's $1 too much.
yeah,
And I'll also say, just for your sake, we are not providing tax advice. This is not us providing tax advice. This is not legal advice. So
yeah,
I'll put that in there
absolutely,
just so everybody's got it.
absolutely. Not tax advice, not legal advice. Meant to provide education. If you have a specific question, you should ask a professional about it. But that was awesome. Thanks for going above and beyond on all the kind of explanation, procedure, and mistakes that people make. So I know this is a complicated topic.
Sure. Well, I hold myself to a high standard.
I can tell, and I appreciate that, which is awesome. So let's just zoom out for a second. I think that was a great description of the backdoor Roth IRA. If you could give, one piece of advice on any financial topic to millennial professionals, what would it be?
Two things. The first one in general is, and this is going to be hard to do because I understand the culture around, especially personal finance, because I work in this field. I talk to people every day. And the general sense that people have is, I don't need to hire somebody to do this. I'm probably smarter than whoever's giving me advice. I can do this.
Mm-hmm.
And this may sound harsh to a lot of the people listening what I'm about to say. And I know that it's going to cause a lot of people to say, oh, I'm going to prove them wrong and do it myself. And I can do this and I don't need any advice. But I think, once you talk to older people who, have learned from their mistakes, what they'll tell you, and just in my case is I work with a lot of older physicians who are really passionate about connecting me with younger physicians who think that they're smarter than everybody else and they don't need to hire a financial planner, right? Which they may be right. Everybody's got an example of, well, I know this guy who did it himself, or, something like that. But we're just talking in general about general advice. Is what those older physicians almost always say is, you're too busy. You shouldn't do this. You're not only risking your own financial life, but, if you have a family, you have kids, really responsible for you just to kind of be Googling stuff and trying to figure everything out yourself. And so my general advice is like, you're busy, you do what you do. Our economy, there's this beautiful thing called specialization. You do what you do. It's okay to hire somebody. You're not losing. You're not losing by hiring somebody and asking them for advice and to have them do a lot of this stuff that doesn't take up your time so you can spend that time with your family. So that's my general advice is, because even a lot of people thinking this, I know just from talking to people, that they think, well, Mike's just told me everything I need to know about this Backdoor Roth IRA. So why do I need him? Right. And they think that, and that's common. Every time you tell somebody something that they don't know as it relates to personal finance, they then think they know everything. So I could say something else right now that nobody listening would know. And after I told them that, they think they know everything. That doesn't make a lot of sense, but it's emotionally how people think. And it'd be analogous to me going to the car mechanic and him saying, well, and I just did this, so that's why I'm giving the example. And him saying, yeah, you bought that car, it was certified pre-owned, but they don't check the alignment of the tires. And so your tires have, they've been aligned incorrectly and they're all cupped, and that's where you're getting the road noise. It wouldn't really be logical for me to say, oh, well, now that I know that, I'm just going to align my tires myself, assuming that I have the capacity to do that, and never go back to this mechanic again, right? And, and people make the argument of, oh, well, it's not like a car mechanic because, I can actually look up how to Google this stuff, right? The point is a good one, even considering that. So, I would definitely consider doing that. The second thing, and, this is especially with millennials in particular, since you're asking about them and for any millennial physicians, right, is you should purchase disability insurance. Okay. Nobody wants to purchase it. Right. And I always give this example. I talk to residents, I talk to fellows, even, younger attendings that are kind of in that millennial range. And I tell them, I give talks to groups of residents, it might be like 50 residents in a room, and I give a talk. And I like to say is, if you were me up here as one of the residents, if you were me given this presentation and you knew that, like 1 out of 3 or 1 out of 4 of you were going to suffer a long-term disability before the age of 65, and that 1 in 10 of you would be completely disabled before age 65, wouldn't you recommend all 50 of you to purchase disability insurance? Because, statistically, right, that, 10% of you are going to get complete disabilities, meaning you can't do what you do now. Doesn't mean that you can't do anything, but just that you can't do what you're doing now from an own occupation perspective. Right. They're going to suffer long-term disability, and they're going to say, well, of course you would. But what happens is when you ask each individual person, they go, oh, that's expensive. I'm probably not going to get disabled, right? And your biggest risk is not that you don't take advantage of the IRAs. It's not that you don't, that you get a little bit less of a return to your investment account. The big risk is that you get disabled, you don't have any income, right? And that's almost scary to people. But it's like, well, confront that face on. What would you do if you got disabled to the point where you couldn't earn an income? Well, if you don't come from a family that can provide you resources, you're kind of going to be in a bad situation.
Yeah.
So disability insurance is incredibly important. And, even after saying that, I know people won't purchase it. I know because I work with a lot of people.
Right.
But it takes really a lot of hubris, especially when you have a family, and a lot of irresponsibility to not have disability insurance. Again, it's not just about you once you have a family. It's about anybody else who's a dependent of yours as well.
Yeah, absolutely. And I want to point out that, you're a fee-only financial planner. So it's not like you would make any money from the people getting disability insurance. You're probably actually going to annoy them. So the fact that you're saying this, like you're an unbiased source. And I totally agree with
And
both
not
of you.
not only do I not get compensated, but it's actually all the money that they pay in premiums for the disability insurance, which of course the client's going to think is too much. It's all the less money they're going to save that goes into an account that I would be billing on. Right. So, because you're right, they're thinking, oh, well, this person just wants to sell me the insurance. Right. But as you pointed out, not only do I not get compensated for it, right, but less money gets saved into the account that I manage. So why would I do that? Well, here's the kicker. Here's the reason why I do it. Because I, unlike a lot of people, respect the risk that you may get disabled. Sure. And if you do get disabled, guess where the money's coming from to pay for all your living expenses and your family? Out of the accounts that I manage, right? It's I share the same risk that the individual faces. Sure. So by telling my clients to purchase adequate disability insurance, by telling my clients to purchase adequate life insurance, or we're talking about a lot of millennials, so they may not have families, but by telling them to purchase, the adequate property and casualty insurance, auto and homeowners, to which everybody's going to say, oh, I have that. I got it through this. And they have no idea what it covers, right? I'm protecting my own business. Sure. By making sure I'm protecting their income, their assets, and all that.
Excellent. Well, fantastic. That was great advice. I know we're coming up on time here, so I'm going to skip to our last question, which is, how can listeners follow and connect with you?
Yeah, well, I don't have a Twitter account or a Facebook or, anything like that for my business. And I really spend my time working with existing clients and working with prospective clients. But if you do want to have a conversation with me, you can go to caligiurifinancial.com. And so you can just try to type that into Google. Do your best efforts to spell Caligiuri. It's Caligiuri. GI makes a J sound in Italian. So Caligiuri Financial. And right on the website, you can schedule a complimentary consultation, which means it doesn't cost you anything to talk with me. You can ask me some questions. You can learn about the services I provide, and see if they make sense for you.
Fantastic. Well, if you're considering that, I would definitely recommend reaching out to Mike and having that conversation. So, well, thank you again, Mike, for coming on and for your super valuable insights and tips around the Backdoor Roth. It was great.
Yeah, no problem. Pleasure to be on the show, and I wish you and all the listeners the best of luck.
Thank you. And thank you to the listeners for checking out today's episode. For more personal finance tips, you can always also check out my website, savingsacademy.com. And if you found today's episode useful, I would greatly appreciate you leaving me a rating or review so more people can learn about the show. And that's everything for today. Until next time, keep saving, my friends.